Welcome to another episode of Mike on Money. I'm Michael Reese, certified financial planner and founder of Centennial Advisors, creator of the Prosperity Planning System, and, a bunch of other stuff. Anyway, got a great episode today. We are talking about the difference between mutual funds and exchange-traded funds. I find that in the financial world, we are very clear on the differences, and there's a reason that most financial advisors are moving towards exchange-traded funds. Yet, I also find that the average person, if you don't live in the world that we live in, you're probably not super clear about the difference. So I thought, what the heck, this would be a great opportunity to share. So before I dive in, remember, as always, if you like this episode, just click that thumbs up button. Give us some comments below if you'd like. Subscribe, that's always good. Don't want to miss an episode. And of course, you can share this with your friends, neighbors, and countrymen. All righty, as we dive into today's topic, let's play a little game. Let's imagine that you've got, $100,000 that you want to invest. And I come to you as the super smart financial advisor and I say, have I got an investment for you? And you're like, tell me more, Mike, I want to hear. You say, okay, here's how it works. With this money, we're going to put your $100,000 into this investment, but here's how it's going to work. I don't really know the price that we're going to invest your money at. I'm not quite sure what price I'm going to buy in at. And later on when we sell it, I'm not real sure what we're going to sell it at. I don't know the price we're going to buy at. I don't know the price we're going to sell it at. I kind of know, but not really. And you're probably already thinking, I don't know, Mike, that doesn't sound so good. Well, let's keep going. But wait, there's more. I can tell you some of the fees that you're going to be paying, but there are going to be these other fees. We're never going to have an idea what all the fees are in this investment. There's some fees we see, and then there are a bunch of hidden fees. We're never going to be sure exactly what you're going to pay. So we don't know what price we're going to buy at, we don't know what price we're going to sell at, and we don't know what you're going to pay for fees on the money that's invested. How you like this so far? I mean, I know what you're thinking. You're thinking, wait a minute, Mike, I thought you were this super smart financial advisor. Something's not matching up. I say, no, but wait, there's more. We're not real sure exactly how the money's going to be invested. We kind of know, but we don't really know. We're just kind of guessing. I know. You're sitting there like, oh, wait a minute here, Mike. Let me get this straight. You don't know what price I'm going to buy in at. You don't know what price I'm going to sell at down the road. I don't even know what the fees are going to be that I'm going to pay. And I don't know what I'm invested in? Seriously? You want me to put money in this? And I'm sitting there going, oh no, but there's even more, right? There's even more. If this $100,000 that we're investing, if it's not in an IRA or some kind of tax shelter, if it's just like a regular investment account, we're going to have some kind of goofy tax rules that we have to deal with. Some years you'll make money, you'll hardly pay any tax. And some years you'll lose money and you have to pay a bunch of tax. You have to pay gains sometimes in years where you lose money. And then, it's not I buy it and I don't pay tax till I sell it. Every year there's something weird going on. Oh my God, Mike, come on here, man. Let's see, I don't know the price I'm going to buy or sell. I don't know what I'm going to pay in fees. I don't really know what I own. And I got weird tax rules if it's not in an IRA. I'm like, yeah, right? Put some money in? And you're going to be looking at me like, what are you, crazy? What is wrong with you? I would never put money in something like that. Well, most people wouldn't when it's described that way. But what did I just describe? I just described your average mutual fund. That is exactly how mutual funds work. I mean, think about it. When you decide to invest in a mutual fund, you don't know what price you're going to invest at. You get the price at the end of the day. Whatever it's worth at the end of the day, that's the price you get. So you kind of know, but you're never sure. Same is true when you sell. If you want to sell out, you get the price at the end of the day. You could decide at 10 a.m. in the morning, I want out. You put your order in to sell that fund. Guess what? It doesn't get sold till the end of the day until we figure out what the price is going to be. So that's a problem. Next, they're not transparent. The fees. Let's talk about the fees. There's no transparency for fees or investments. Yeah, they give you a prospectus. They say these are kind of the fees that we know we're going to charge you, but there are a number of fees that they don't know what are going to be, like trading expenses and other fees that happen internally, and you never know what those are going to be. So every time you get a prospectus, you see part of the fees, never all of the fees. And we're never going to know what they are. Same with investments. You get like a biannual report. Twice a year they give you a report and they say, hey, here's everything that we hold. By the time you get that report, half that stuff's already gone. You never know exactly what you hold. Hey, do I own Microsoft or not? Who knows? And then, of course, taxes are just plain goofy with mutual funds. So even though we have those disadvantages with mutual funds have driven an explosion of wealth in this country. Well, you know how it works in the computer world, right? You always have the first version 1.0, and then you have the second version 2.0, and so on. Well, today in the investment world, we have these things now called exchange-traded funds. And quite frankly, they're a lot like mutual funds 2.0. Now, what do I mean by that? What exchange-traded funds essentially do is to take all the good stuff with mutual funds. Hey, with a mutual fund, I can be diversified without a lot of money. I can deposit regularly, and I don't have to have a ton of money to deposit in, and so on. So it takes all the benefits of mutual funds, but it also essentially eliminates the bad stuff. So with an exchange-traded fund, let's start with the first one. You know exactly the price you buy and sell at. Exchange-traded funds are sold throughout the day. So you can buy in at a certain price, you can get out at a certain price. You know the price you're investing, you know the price you sell at, which is what we would call normal. Next, fees. Full transparency with these ETFs. You know exactly what you pay. And normally the price is pretty darn small. Third, transparency. You know exactly what you own in an ETF or an exchange-traded fund. ETF is what they call them, at all times. Mutual fund, I don't know for sure what I own. I only think I kind of know what I own. But in ETF, you definitely know what you own. And then fourth, taxes. ETFs, generally speaking, not always, generally speaking, are very tax efficient. They work exactly the way you would expect. It's like, oh, I buy in, and if I've got dividends or interest each year, I just kind of pay on that dividends and interest. But capital gains, when you pay those later on when you choose to sell. If it's in an IRA or Roth IRA or something, obviously those tax rules apply, but they're much cleaner from a tax perspective. So when you hear the phrase exchange-traded fund, often referred to as ETF, what are they? They're basically mutual funds 2.0. And all of your top financial advisors and your top investment people, you don't really see them managing a lot of mutual funds anymore. They're all moving to ETFs. Why? Because you get all the good stuff of a mutual fund, but none of the bad, or like almost none of the bad. How about that? So mutual funds, kind of old school, like horse and carriage stuff. ETFs, brand new Corvette. How about that? All righty. That's the difference between mutual funds and ETFs. If you found this helpful, make sure you hit the like button, subscribe, share this with your friends, and I hope to catch you on our next episode. See you soon.